The thing that makes our situation complex, and this is not unusual, we had 63 different financial institutions as our quote banks. Some of them were actual banks, big names, Bank of America, for example, but a lot of them are also hedge funds and mutual funds and debt funds. So you had 63 different interests across 3 different tranches of debt. The revolver piece had one group. You had a first lien debt that was mostly banks, and then you had a second lien tranche of debt that is mostly hedge funds. And they all have different ideas of what the company could be worth or what to do in this situation, which is why it would be so unusual for them to all accept the company's initial proposal. So what they do in a situation like that is they basically say, look, you're going to have to go through a Chapter 11, which is just a reorganization of the debt and the equity in this particular case. And it's not the end of the world. It's just we got to come up with a way to haircut the debt to a lesser size and reduce the equity holdings. People that hold the equity, they're going to have to probably lose all of their equity, which in this case, they virtually lost most of their equity.
Hello and welcome to the Gross Profit Podcast. My name is James Kennedy. I'm the CEO and co-founder at procurementexpress.com. We take the hassle out of managing your company's spend with magical features, but we're not here to talk about that today. Instead, at the beginning of 2024, I think a lot of business leaders are wondering when the other shoe is going to drop. We've been at the end of a historic stock market run of growth and prosperity. Numbers look great in the US right now, slightly less so in Europe, but overall unemployment is low, growth is high, and it seems like the party is just never going to end. However, we all know at some stage it will, and today we're going to learn more about some of the things you might need to consider and get ready for should that happen to you in your business, especially if you've been using debt, especially in the ZIRP era of zero interest rate period that we've just come out of now. Maybe your business has used debt to help fuel growth. Beware, out there are people waiting in the wings for things to turn south. These are distressed debt investment funds waiting for the economy to turn, waiting for companies to get into problems with their debt. And today, I've got someone who's already been through it, at least once, from the last downturn, Eric Neumann. Eric and I had a great chat yesterday where he explained to me what a distressed debt hedge fund is, what they do, and more importantly, how to survive one. And he was on the receiving end of that. And we're going to hear a little bit more about this in this interview. So, Eric, thanks very much for coming along today. I'm really looking forward to hearing this story. Maybe you could just tell the listeners a little bit about you and your background and where you are in the world.
I've been doing accounting and finance CFO work for 30 plus years in different industries, radio, billboard. I've also worked in craft brewery, and I've been working with restaurant company, a small family-owned restaurant company. Currently, I'm with a company called New Life CFO that does fractional CFO work for small to mid-sized companies, typically, 5 million to say 70, 80 million of revenue type companies. Typically they call us when they have things not going well and want to get our financial acumen to help them out because they typically are too small to have a full-time CFO, but need that financial expertise to help them solve some of their problems and maybe get more sophisticated about their ability to understand their business and figure out how to get it more healthy.
Maybe we can just bring us back to 2009 or so. You referenced your experience in the billboard industry there. How did it impact that business you were working in?
I was hired in the beginning of 2008 for this radio company, billboard company. They're about almost 50-50 of revenue in billboards. And they had professional investors as their equity folks, big name funds that you would know the name of right off the top of your head. They had debt that was publicly traded. And, they just weren't making their numbers, is what it came down to in early 08 and coming off of 07. And a lot of it had to do with the radio industry just sort of going through this cycle. It started in 2000, sort of a slow crawling decline due to the online competition for audio. That industry's had a lot of resilience relative to the overall trend, but it still has had a decline. Didn't have the growth rate that it used to have in the 90s when I first was involved in radio. throughout the entire 1990s. We had to come in and restructure the debt. It was about $325 million. It wasn't very controversial. It was just one of those things where we just worked with about 60 different lenders because our debt was syndicated, which meant that we had kind of a complicated debt structure. But we just basically renegotiated with the lender groups represented by key banks that led them. And we restructured the debt and decided that they would give us new covenants, which was great. We paid them a hefty fee for the privilege of doing that. But it was real clear by December of 2008, after we restructured in spring of '08, that the new covenants weren't going to last into the new year of 2009, that we were going to break our loan covenants yet again because we just had too much leverage and weren't able to grow that top line. And therefore, that affected the bottom line.
Let's dig into those covenants a little bit. Where were the agreements that they entered into that actually ended up catching them out in the end?
Back then, we had several different covenants that we had to comply with on a quarterly basis or annual basis. And one of them was the interest coverage test, which just made sure that we had enough EBITDA or profit to cover our annual interest payments. And it was a ratio that just had to ensure that you could always do that on a 12-month trailing basis. And, it didn't really take into account the fact that we had cash or borrowing power, but it does take into account the fact that when things get tight on covering your interest payment, there must be a problem, which is true. We had created enough cushions in the spring of '08, but when we were starting to do our forecast in December of '08 for the 2009 year, it became apparent that by second quarter of 2009, we were going to miss that covenant by 1/10 of a point, which is all it takes to break the covenant, which forces you back into a restructure mode or a life of compliance.
A feature of this business is most of the sales is pre-booked, right? That's the impression I got, in that you had a 3 or 6 month view of what the sales were going to be. Great business in that sense. So the finance team, they saw the canary in the mine straight away, I guess. Were you the guy who put your hand up? Did anyone want to hear the message? How did that go down when you had to come in and say, listen, I can see what's going to happen? Because everything looked fine, right? Cash in the bank, everything else looked good. And suddenly Eric's being awkward here, showing up with this bad news.
Well, as you might imagine, in a lot of industries, certainly in the radio and billboard industry, it's full of salespeople, salesmen, sales personalities,
right.
Management that come from sales, which is all a good thing. And the optimism when we were doing our original forecast for 2009 was that we were going to grow 5%. And I'm sitting here looking at what was already happening in Q4 of '08 historical, and I'm looking at the first 6 months of '09, which we have visibility in that industry to see what advertising is already on the books, because there's a lot of pre-booking that goes on in both industries, has forever. So you can really see the difference. And that if you're down 50% in bookings, it's not going to just recover. It's not going to go back to 100%. It just won't happen. When I got the original forecast and they were all growing 5%, I just had to, call that out as not going to happen, guys. And I did my own kind of reforecast of everybody's numbers. And I'm looking at the trends going, yeah, we're going to have a big decline here. We're going to miss our numbers by a mile. And in fact, we're more likely to have a 15% revenue decline. And that means, as that trickles down to the numbers, and, as a side note, we'd already done $3.6 million of cost savings in 2008. So we already cut everything that we could. It was just real simple. Revenue wouldn't drop to the bottom line to make those numbers work.
Let's say, if to explain this in a way I can understand, so let's say for every 300,000 in debt they had to repay on an annual basis, they had to book $1 million in EBITDA to cover that. Was that it? And there was that ratio that got out of whack.
Exactly. That's the concept. Yep.
I'm fascinated. So I can imagine you come to board, they're like, you got the problem. Let me hear the solutions, especially a room full of salespeople. They're like, no, we've been in tough spots before. There's money in the bank. There must have been a temptation for, let's say, a bit of ambiguity or maybe reforecasting or whatever.
Right.
And what were the conversations like? And why did you choose to stand firm? What was your decision-making process there rather than trying to come up with a more creative approach?
Right. Well, once we internally got a handle on the fair forecast for the year 2009, it was then time to go to the board and present the numbers. And, these were all the funds that were our equity investors sitting on the board. And they certainly didn't want to hear about how we were going to miss covenants, because one of the covenants we also had was if we put forth a forecast that reflects a future default, that is also put you into default, which is a very unusual covenant. And I don't even think that exists anymore. But at the time it did. And so that was really kind of a preemptive default to the actual event, which was a really hard pill to swallow. But my whole argument to the board was, we really need to present what we truthfully believe will happen, because otherwise, if we don't, we're going to have a credibility problem, because we're going to miss our numbers. We're not going to be able to hit the targets we need. And there's not a lot we can do about it. It's not negative attitude or just, not doing our best. It's we can't control the fact that most of the advertisers in America have cut back or canceled across the board, local, national. I mean, we are talking late 08, post-market crash in September of 08, going into 09. First thing everybody cuts is advertising. And it was quite the argument at the board level about putting forth numbers to our banks, thereby triggering a default. So not popular, but it was, one of the key board members did take my side and stood with me on the concept of integrity is far more important here to have a better negotiation, because it's going to happen. So let's just deal with it above board in the first place. Because if we lose credibility, the banks become empowered to control your company because they control the debt in that situation, and they can legally force out management.
What happened next? And the decision was made. I'm sure it wasn't that easy. There's a few heated conversations, let's call it. And then you decide, okay, we're calling the bank. The CEO makes that call. You make that call, bring them in, explain what's happening, and what happened from there.
That's pretty much, fell into my domain to file the right documents with the banks and let them know, here's the situation. We, of course, had a conference call that we scheduled to walk them through a PowerPoint presentation, walking through our math, our numbers, our logic, our rationale, why we believe this to be true, as well as a proposal, how we thought we could even fix it, with granting some banks in the second tier of the loan some equity in the company and downsizing the amount of the debt. But they didn't bite. That wasn't, I was too clean and simple solution, and they weren't going to bite on something like that. So this is a classic case of why companies end up in Chapter 11 bankruptcy in these situations.
The first attempt was, hey, Mr. Bank, we'll give you shares in our company if you forgive some of the debt. So basically try and get them to be investors. And you obviously had a pitch on that. And they were, no thanks, we don't want to be in the billboard industry. We're in the closing down business industry. And then you mentioned Chapter 11. So who does that? Is that you? Is that the bank? Do they call in the Chapter 11 cops?
No, not really. It's the thing that makes our situation complex, and this is not unusual. We had 63 different financial institutions as our quote banks. Some of them were actual banks, like the big names, Bank of America, for example. Merrill Lynch was involved. But a lot of them are also hedge funds and mutual funds and debt funds. So you had 63 different interests across 3 different tranches of debt. The revolver piece had one group. You had a first lien debt that was mostly banks, and then you had a second lien tranche of debt that is mostly hedge funds. And they all have different ideas of what the company could be worth or what to do in this situation, which is why it would be so unusual for them to all accept the company's initial proposal. So what they do in a situation like that is they basically say, look, you're going to have to go through a Chapter 11, which is just a reorganization of the debt and the equity in this particular case. And it's not the end of the world. It's just we got to come up with a way to haircut the debt to a lesser size and reduce the equity holdings. Or the people that hold the equity, they're going to have to probably lose all of their equity, which in this case, they virtually lost most of their equity. 99.5%, which is very normal in that process. But it's more of an agreed on process. The second lien had their team of attorneys. The first lien had a separate team of attorneys. We had our attorneys. There's just a lot of attorneys involved, process involved, filing of paperwork. And it's this process that goes on for months. It's not fun.
Presumably the board is made out of people mostly who are going to get wiped out in this process. That's why they would rather take anything else.
Yes, that's right. That's why most of them were pushing back. The one that more or less took our company's side was more or less looking for, let's find a way to negotiate with the banks and give up some of our equity, because there's no way that we don't lose some, which seemed like a reasonable way to go. But you have too many disparate interests in a situation like ours to really control a transaction. straightforward of a methodology.
And the interesting thing here is that they have plenty of cash in the bank. So like if they were, let's say, a VC-backed startup, it would be totally normal. Loss-making, ton of money in the bank, and they would be allowed to operate. What's the difference there between a VC-backed startup that you know is making no money and has cash in the bank, and they're allowed to stay out of Chapter 11, and you were made to go into it?
Right. Well, the difference is they don't have debt. Typically, it's a pure equity investment, and they keep piling on equity to chase the losses until they believe that they've got enough market share to then focus on getting the company to be more of a viable business that can have debt. Because, of course, debt's cheaper than equity. Equity wants 20 to 40% returns, where debt, at that time was looking for 7 to 8 to 12% returns. And, you can't have debt unless you have cash flow, meaningful cash flow.
Lower risk, lower return.
Yeah. So, it's better for the equity to have a healthy amount of debt on the company. But in our case, we had like seven times debt, which, in the 90s, that wasn't too much debt for a radio billboard company. Even in the early 2000s, that wasn't too much debt. But by the mid-2000s, 5 times was about as high as you could go to be healthy, given that the fact you couldn't count on top-line growth at mid-single digits anymore. It was more like growth at 1% to 2% in a good year, right, and a bad year flat to down 1% to 2%. So cases like that, 7 times debt will kill you.
I'm curious, how does that compare to 2024 levels?
We're basically at those same interest rate levels right now. I think the difference from what I've seen is most companies across all industries are closer to 4 to 5 times leverage. There was just a lot more leverage pushing the envelope going on in the early 2000s because of the fact that in the 90s, many industries, including the radio billboard, got away with 7, 8 times leverage. And it worked out. There wasn't really a lot of problem there, but that industry grew, high single digit to low double digit annually.
So I guess the regulation is tighter today. The ratios are tighter. What the banks are allowed to give out.
I would argue that the covenants are lighter from what I've seen. They're not tighter. The regulation at SEC might be theoretically tighter, but from what I've seen, leverage is smaller, which is better and healthier in general. But there's also the covenants that I've seen or heard of tend to be lighter than what we were dealing with. I can only speak to that as a reflection of what happened with Enron in 2000, 2001. That's why our covenants were so difficult at the time. We were still dealing with that blowback. But a lot of that's been relaxed since then, and to my knowledge has not come back to that level. But there's still always this general concept with any bank loan. There is a certain point where you cross a line that the bank has to step in with the attorneys and figure out a way to restructure your debt and equity.
There are funds which specialize in this sort of, let's call it turnaround, distressed debt funds. And were they already on the cap table, or how did they come to find out about this opportunity from their perspective?
There's these funds out there that have distressed debt as part of their portfolio. This is all they focus on, is companies that are pushing their limits with covenants. And there's so many companies that are often, up against the wall. And so they follow these companies very carefully. And the reason they can do this is because of Bloomberg service that is offered, a very expensive service, but of course it's inexpensive for them in the relative game. But they look for these companies and they look at their screens every day and they look for who's not making their numbers or who might be missing their numbers in the future. And they study the debt documents. They get them online and they can read them because this is publicly traded debt in the grandest, broadest definition of what that means. Not necessarily SEC regulated, but there is debt that trades that isn't SEC directly regulated, I should say. And that's where ours fell in. So they were able to see our debt, understand it, see our situation unfold, and quietly, without us knowing anything about it, start buying up little chunks of our debt on the free market. And, typically our debt didn't trade. Typically you buy the debt of our company as one of these funds or these banks, and they'd sit on it for months and never make a trade, if not years. But when you're in a distressed debt situation in an economy that's swooning, all of a sudden the market says, well, your debt might have been worth 98 cents on the dollar when you issued it, but now it's worth 70 cents on the dollar or 50 cents on the dollar. These guys look for these opportunities and start buying it quietly and carefully. And they either buy it and then look to exit. Maybe they buy it at 50 cents, the economy comes back or the company comes back, and they see that it's ranked up back at 80 cents a dollar. They sell it, they make a nice profit. Or in our case, some companies, we had 3 of them chasing us at the time, were buying it up quietly, and they were looking to own it. They were looking to buy enough debt to eventually take a 51% share, and then they have the right to control our company because they are now the debtors in possession of our debt and the majority, and therefore they can guide us and control us. And, it was a bit of a dance we had to do with these 3 different funds. Ultimately, one of the funds stepped out of the equation by their own choice, and the other 2 decided to collaborate and effectively buy us together. And they also agreed to put in, $55 million of fresh new equity so that we could be properly capitalized, downsize the debt, kick out all the original equity, save 0.5%, and then take the second lien tranche of debt and convert all those people to equity. And then allow for the first lien debt to be repaid in full, and then refinance the whole company with fresh new loans from fresh new debtors that are totally aware of the whole situation. But in that case, they could see that we're refreshed, proper amount of debt on the books now, 5 times leverage, likely to grow out of it.
Right.
And that whole process started in December of 2009 and culminated in May of 10. And by May of 10, we had already seen the 3 to 6 month trend line start to swoop up a little bit and level out.
There was kind of a technical default rather than running out of money, which I guess has made them interested. So there was also cash in the business. Was the asset value enough to cover the debt, like if it had to be unwound?
Yeah. Liquidating would have only lost further money for everybody. So they all understood that. It would be a fire sale in that situation. You wouldn't want to sell assets in 08, 09, or even early 10. That would have been a bad idea. So the whole vision that they had was, let's turn this company around. Let's find some new ways to grow. Let's find a way to grow back better and higher than what we would do under normal circumstances. We want to get this company to be more valuable than it was before everything started to decline in late 07. And that's what this distressed investor team really wanted, was a situation where we could turn it around over a 3-year period and grow the company quickly. And then they wanted to sell it. Loan to own, 3 years and out, very typical for a distressed debt fund that takes possession of a company.
So the original debt holders, let's call them that, weren't stupid, but there needed to be some other strategy. It wasn't just a paper exercise of shuffling stuff around and putting some money in the business. Who came up with the story or the vision for what the business could be after that?
That's really, the whole management team. We always work together. We certainly believe in that business at the time. The beauty of the radio business is the fact that it has FCC licenses. You just can't put a radio station on the air. Basically, all the viable licenses were long since taken many years ago. So it's an important position that you have in the airwaves of any particular city. And on the billboard side, most billboards are grandfathered in by a local county or the city, or in a way where you can't take them down. So you've got this permanent placard, if you will, to put an advertisement on that nobody can get rid of legally. So that's part of the stability of that business, despite the online competition. However, you can't ignore the fact that dollars are shifted away from those places, more on the radio side than on the billboard side. The billboard space is still a very viable advertising medium today, very good business, still grows, still a really good business. Our whole thesis at the time was we can do things on the radio side that we were only starting to do when I first got there in 08, and we knew we were improving those methodologies of becoming a digital marketing agency for local advertisers, so that we could get local advertisers like your local furniture retailer or restaurant to come to us as the experts in helping them, not just with a radio schedule, but also how to do Google search terms, how to have a texting campaign, how to make their website useful and interactive and help grab people in to want to go to their restaurant or go to their furniture store. So we basically hired a small team of 30-something-year-olds that understood all this new technology and sent out in each market. We had 130-something go out with a regular salesperson. And on one hand, you're hearing about why to buy radio. On the other hand, you're hearing about how this young kid can help clean up and fix your website, give you some online marketing campaigns, make sure you're number one in the search for Mexican food if you're a Mexican restaurant, for example. And now all of a sudden we're charging them separately for this expertise service. The idea being is that we know we're being under attack from digital marketing agencies in every city. There's many all over the country, thousands probably. And there's no digital marketing agency worth their salt that's ever going to recommend a radio schedule. It'll never happen. So our battle on the radio side was, let's be that digital marketing agency for our local advertisers. Let's be the tip of the spear of solving their problem of having an online strategy. Oh, and by the way, sell a radio schedule at the same time without any discounting or cannibalization. You got to show them value on both sides of the equation. And that worked. And we did grow our radio company back. We did get back to the numbers we were at previously in 2007 and then some. We were out-indexed our peers on revenue growth rate in 2011, 12, and 13 when we finally sold those stations. That was the mission. That's the plan. And it worked out. We were able to sell those radio stations at a relative premium in 12, 13. On the outdoor side, different strategy. At the time we went into bankruptcy, we had 5 digital billboards. Digital billboards were a relatively new strategy where you could have 5 to 7 ads run on the same digital board. They're very expensive to build, $200,000, $300,000 to build one of these things to replace an existing static billboard. But if you build them and get enough new advertising dollars from existing or new advertisers, you can justify that $300,000 expenditure in 3 to 5 years. And we hadn't done it prior, but what we said was to our new distressed equity partner, hey, give us $10 million. We'll go build a whole bunch of these things in the best locations of where we already owned, and we will turn that around and grow our revenue. And we did. We built 63 boards in 18 months, and we grew our revenue on those same spots that were previously static digital boards. We grew our revenue 11 times, and that was huge. So we ended up putting $2 million on the books that was never going to be there before, and we did it without cannibalizing existing ad dollars from advertisers. And that was key, was not cannibalizing, because just shifting your advertiser from a static to a digital, you're just moving pockets, and that's not the same thing. So that allowed us to sell our billboard facility, or plant, I should say, 6,100 boards in 2012 to the largest outdoor billboard company in the United States. And they paid a premium because their stock traded at a premium, and they could buy it at a higher price than anybody else could. So we were able to get our distressed debt / equity investors happy. They ended up with a 15% return on their investment, and that's all they were looking for.
Let me ask about that. So 2 questions. One is, they bought up the debt quietly, you said. When was the moment you realized that they were doing this? How did you figure it out? And what's with all the secrecy?
They probably started buying it in spring, summer of 2009. And we really got into negotiations with them in late summer, all 3 of them. And we knew it put me in a really tough position. As a CFO, you have to wear multiple hats when you are in a bankruptcy situation to look out for your existing shareholders. You got to look out for the banks. And because you can see what's about to happen with who's going to likely be your new partner, you got to wear a hat looking out for them. These hats are all in conflict. They're not all on the same page.
Right.
So you had to walk a fine line and not communicate across lines of who was doing what. And it really made for some awkward moments where I knew what one side was doing in their strategy and their pricing, and I knew what the other side was doing. And I could not, and I did not say anything to either side. I just had to keep it all to myself and just sort of let the cards play out, because that is the ethically correct thing. And is also, as my attorney advised, if you communicate anything, you can end up, lawsuit for not following the fiduciary responsibilities or fiduciary duties. You have to keep it real close to the vest and let the market really decide who's going to end up buying up enough debt to take control of the debt itself and end up being your partner, whether you like it or not.
Yeah, super awkward dealing with the equity side, especially, they're about to lose their baby, basically, get kicked out on the street. You can see it happening. Did you have to hire a personal lawyer to figure out how to keep you out of trouble here?
Corporate attorney. Yeah.
I didn't even think of that. But yeah, you're just a W-2 employee, right, at this stage. How come you could be legally on the hook?
Well, it's really under the protection of the corporation. Not me personally, but the corporation. I have a duty to the corporation to protect it. And I have a duty to manage these fiduciary responsibilities in balance. It is a vague area of the law as near as I can tell. I don't know where the envelope has been pushed, but I just know that, our corporate attorney and our bankruptcy attorney, separate people, same firm, advised us every step of the way, the right way to go through these procedures. It's not something you do on your own. It's not something you guess. It's something that is tried and true, and there's a procedure. It's a very painful procedure, but, it's the only way to get it done.
How was this personally during this period? I mean, these are people obviously you had relationships with. Did it have an impact on you?
It was one of those things where it was a negative experience, but it wasn't like it dragged me down personally or made me feel unhappy. It was more like, this is a serious problem and you just have to take care of everybody as best you can and communicate as best you can with everyone, all parties, do justice to everyone by being above board and truthful, and just try to do the right thing every step of the way. So to me, it was a lot of weight on the shoulders, but at the same time, it was a net positive experience because we were able to accomplish what we needed to within the confines of the law and balancing out those competing interests.
You seem very cool and professional about it now. I wonder if I was teleported back into that moment, how you would feel about it. But it seems very stressful. Before we move on to happier times and what you're doing right now, what advice would you give to someone on the finance team? They realize that a distressed debt fund is building a position. What's the big advice you would give to them and how to react and how to interact with them?
You're going to have to learn their culture. You're going to have to learn the kind of metrics they want. You're going to have to learn. They're going to be very difficult to get along with if you're trying to maintain everything you were doing before. They'll be easy to get along with, or easier to get along with, if you realize you're going to have to kowtow to their needs. They're not going to have the same interest that the original private equity has. Hey, we're going to grow this company. We'll do some acquisitions. We'll do some these, maybe we're around for 7 years, 10 years. I mean, these guys, no matter what they say, it's a short timeline. They're not going to do acquisitions. They'll look at them. And we did look at some acquisitions while we were in that few-year period there. But they turned down every one of them except one, which didn't shock us because we knew that was likely. They wouldn't do an acquisition unless it was immediately accretive. They weren't interested in acquisitions that might have made sense. Give it 3 years. Sure, it'll absolutely make sense in 3 years. It'll all pay for itself and then some because they want to get out quicker if they can. That's their mandate. So you have to recognize that. And these folks put a lot of extra metrics on us. When I got to the company, our board presentation was 24 slides long in PowerPoint. And, the last year and a half, 2 years of that company with this new board controlled by this distressed debt guys, our quarterly board meetings were a day and a half. And we went through 115 slides in PowerPoint. And we measured more things that were so frustrating to the management team because they never been measured on some of these metrics. And how many salespeople have we hired this week? And how many openings do you have this week? And who did you talk to this week to try to hire a new salesperson? And why didn't you talk to somebody that was a new they got into the real details of running our day-to-day business for every single market because they had to be sure that we were absolutely working as hard as we could to bring value to the company and grow that revenue and get that bottom line up so they could sell sooner than later at the highest possible price. They weren't going to trust me. I'm doing a good job. We're doing our best. They weren't going to accept that. Not going to happen. Prove it.
Interesting. Sounds terrible. Sounds like just the worst sort of micromanagement from the board. I'm empathizing with the people who built that business, and you dedicate decades maybe to building it up, and then someone comes in, presumably with an MBA from Harvard or somewhere,
yep.
And then they're telling you how to run your business when you've been blood, sweat, and tears and stuff for decades.
Less about how to be fair and more about a lot of questions about how you're doing your business and why you're making that decision, and how do you validate that it works or that's the best answer.
Right.
And when it's couched that way, it's like you really find out fast. A lot of the stuff you might have been doing you thought was the right way may have not been the best way. And that's tough to take when you're exactly what you said. Somebody's built this company up for years and it's worked, and then all of a sudden it's not working, and then everything you do gets questioned to the nth detail.
What's the Chinese expression? May you live in interesting times. That sounds like it was an interesting time. So up to 24, let's talk about what you're doing now. And specifically, you've got another case study here, which is really cool, a lot more uplifting, thankfully.
Yeah.
I'd like to hear a bit about what you are now, because I think they're a good example of the sort of client that you could help.
I have 6 clients currently, different types, different industries. One of the clients I work on is a quintessential perfect client for what we look for and who I can help. Is they've got a nice business, generate maybe 50 million of revenue, good profit margin at 23%, very healthy. They have a reasonable amount of debt on the books, nothing problematic, and they've been running this business like virtually all my clients and virtually all the clients that come to New Life CFO. They more or less run it closer to to instinct or by the seat of their pants. And in this case, this company has done a great job. It's worked out. We looked at all their metrics and did my usual analysis we do with any new client, and we deep dive on all their metrics and numbers, and we show them all kinds of new metrics and numbers they'd never seen before or thought of. And, they're by and large an extremely healthy business. But there's a couple little things we want to fix. Their inventory is not really managed as well as it could be. It doesn't mean inventory is walking out the back door. It just means the books kind of vacillate month to month on how much inventory are on the books, and there's some confusion as to what's the right number. But this is fixable, solvable stuff. So we're going to work with their accounting team to straighten that problem up, and the warehouse team as well. But they called us because they looked at their business and said, we know we're successful. We don't know how successful, but we also look across the street at some of our competitors, being that they're in the retail space and they have competitors in that same space in regions around the country. They looked around and they said, look, I can tell these other guys aren't operating as well as we are. And I wonder what would happen if we could buy some of these guys, shine them up, make them operate a little better. We could probably buy a whole bunch of these folks and really create a lot of value. So, the folks that run this company are really looking for how can we create a really big or valuable company, maybe something that generates 300 million of revenue. So they want to go find a private equity partner and help do acquisitions. They are also exploring the possibility of, creating their own means of manufacturing that might lower some of their costs on what they sell. And for them to do all that, that's why they reached out to us, for myself to help them through this process of getting their company ready to have a private equity partner, because they're not quite ready for that. There's just certain things, private equity partners, distressed debt guys, there's a lot of more similarity than dissimilarity there about the kind of things they want to see, kind of metrics they need to understand. And they need to be able to understand those opportunities that these owners currently see. So I'm there to help them get ready for private equity, and then we'll go introduce them to some private equity folks and see if we can get somebody to take it on. And if they do, great. Then we'll go look at some acquisitions and see if we can expand this company and create a lot more value for them than they could do just trying to grow organically. They know there's only so far they can take it with their current 4-store operation.
Your client knows how to sell widgets to people, but
right.
It'd be the first time they're trying to buy a business. So
right.
Again, that's something else you bring to the table, knowing how to approach people, knowing how to build a pipeline of opportunities. When you're looking for acquisition targets, what's your process?
The process is really what we're starting to go through right now. Is I'm identifying who's in the market. How do we identify how big that market is? Who's got market share? What kind of revenue are we talking about? So I'm looking at a lot of research reports from research firms. I'm looking at exit multiples for companies in the similar space. So I did some research on that just yesterday to understand what do companies expect to be sold for in this area, so that we have a better idea of what the math's going to look like. And then, of course, the next step will be to build out a model, something simple in Excel that kind of takes all this into account, so we know what we're willing to pay for something and what we think we could exit way down the road for, and understand that difference of how much we've got to grow that revenue or the bottom line, because that's ultimately the math that has to be done. You got to know that if you buy something, you got to have real confidence that you can fix it, shine it, make it better. In the 90s, when I was in the radio industry and right at the forefront of all the acquisitions and consolidation of that industry, our little secret formula wasn't so secret, but it was really about cost cuts. It was just that industry was so ripe with costs that just did not need to be there in an economy, in a situation where the top line almost, not quite, took care of itself. There were some sales initiatives too we had to implement, but right out of the gate, we could cost savings. There's always a little bit of trim whenever you start to add up companies. There's always something to save here and there, but I think this is more of a play on efficiencies having to do with inventory management and how you're going to grow that revenue and expand your customer base. And these people seem to really understand that already. Been operating so well at such great margins that it just seems that we just need to be able to communicate that in a way to a private equity firm so they can see that math playing out on these other competitors out in the market that aren't operating at the same margins. And all the analysis I've seen so far indicates that.
The one side is like what's out there in the market, but then there's the sort of motivating factor. How are you going to get them at the right multiple?
Right.
Where are the opportunities in the market from a motivation to sell perspective? Of course, we're on a crest of a wave, you could argue right now. You could play on people's insecurity there, like it's been good for so long, like we talked about at the top of the episode.
This is not sexy and exciting type stuff to younger people. They probably wouldn't even think to jump into this kind of business. So I'm guessing we're going to find a lot of competitors controlled by the older generations. And, they're probably looking to leave and exit and retire life on a golf course somewhere. And, this kind of works to help that happen. People think of, it's a boring widget business. I'm like, no, it's an exciting business that, still has a tremendous amount of legroom and need that's going to go on for decades and decades. It's not fleeting. It's not fading. It's just, you don't go through ebbs and flows, but it's going to be around a long time. So now is a good time to identify that fragment.
Listen, boring businesses, I love them. If there's any whippersnappers out there thinking about starting a purchase order software, don't worry, just go start a YouTube channel or something. These so-called boring businesses just leave it to us guys with gray hair. I'm fine with that. So I ask everyone a question at the end of the podcast. Who would you say is your business hero and why?
I kind of have a unique, or one that wouldn't be typical. I think a lot of people might say Elon Musk or some of these other folks, and there's so many that are great that I look to, but there was one that's always stood out as a real maverick or lone wolf. And that's former president of Ferrari, Luca di Montezemolo. He was born an aristocrat in Italy, ton of money already, still decided to go build up his career through various ventures over the years, including a short stint at Ferrari in the 70s. And then by 91, after Enzo died in 1988, they tapped Luca to become the CEO of Ferrari. And at the time, Ferraris were still known in people that bought those cars as kind of leaky oil buckets that were very fast and looked great. But he turned that company around in the 90s and the early 2000s from that reputation to making much better, sleeker sports cars that were now reliable and very innovative and very cutting edge. He really turned that company around. And at the same time, he also turned around the F1 team, which hadn't won a championship since 1983. And then under his tutelage, he got that F1 team to set a new high bar for records, with Michael Schumacher as the main driver that was behind it all. But it's really the whole team. Anybody that watches Formula One knows that is absolutely a team sport. They got, 8 championships for the constructors and 6 drivers' titles while he was there. He was finally ousted in 2009. I can only speculate as to why. I think it had to do with him forcing Schumacher into early retirement and bringing in Kimi Räikkönen to replace him because he was the new young buck on the grid. Kimi Räikkönen did win the championship that first year. Massa almost won it the second year. Arguably did, if you believe in the penalties and the problems that happened. Either way, I think for some reason the powers that be at Fiat just decided to give him the boot, even despite all the success that he created. And, to this day, those cars that come off the assembly line are still some of the really finest sports cars in the world. He really started something that took that company to another level. My wife and I toured the factory in 99, and I remember, looking it up or looking at some inside Formula One data points that said that company was worth about $800 million in 99 when I toured that factory. And I think they were, put out maybe 4,000 cars a year at that point. And now they're worth $57 billion, and they only put out maybe 6,000 cars a year. I mean, it's amazing when you think of how much market value has been created there because of the brand, because of the Ferrari amusement parks, because he allowed that brand to get leveraged in a way that they always made money. And if you're going to use my brand, you're going to pay me a lot of money to make it happen. It really started with him. He took that company way beyond what Enzo ever envisioned. You never hear about it. There's no book, no movie about the guy that I've ever heard. And I'm like, that guy really transformed that company big time.
Well, riches to riches stories are always a tough sell for the proletariat, I guess.
True. No one's crying for it. Nobody's crying.
Headline, rich guy continues to be rich.
He didn't have to. He could have just sat on the sidelines and bought the cars all day long.
I've come from a fairly privileged background, so I like that one, actually. So maybe I can follow that example. New Life CFO. What's that about? What's the New Life? Where did the inspiration for the name come from?
Yeah, we're in Dallas, Texas. We're a small group of us, maybe a baker's dozen of us. Half of us are CFOs. The other half are accounting people. You just go to our website, newlifecfo.com, kind of talk about it. It's really about, breathing new life into your company one way or another. It's some of our clients, it's about cleaning up the books and getting the bookkeeping done better, which is not what I do explicitly. And for other companies, it's about focusing on the strategic level with the owners, the CEO, the management team, how to get that company to greater potential, greater revenue. And really, what I do has a lot to do with showing people that typically didn't have a CFO because it wouldn't make sense. I mean, very small companies don't need CFOs at all. They only really need them when you start to get bigger and bigger. And you start to have dozens of employees and hundreds of clients. Now it becomes really important to make sure you're maximizing everything. And so we get into metrics with people and trends and peer comparisons and try to help them understand what's possible. And when they understand more about what's possible, then we can focus on strategic plans or tactical plans to get them from where they are today to much greater levels and eventually help them exit down the road and maximize their return. I mean, that's really what it's about. And that's really our role as a CFO, is to help that management team maximize everybody's return at the company. So that's what we do, small to medium companies. And it's a fun little way to spend the day.
Well, listen, I have thoroughly enjoyed this interview. I learned a lot, and thank you very much if you've listened this far into the podcast. I'm always looking for interesting guests like Eric to come on and go deep on an area like distressed debt or budgeting or forecasting or anything else you got out there, anything else I don't know about. The unknown unknowns for me, educate me and maybe the rest of the people listening. And until then, we'll see you in the next one.